Welcome back. Let's get to some corporate conversations then. Lots and lots of companies have been reporting numbers over the last couple of days, and Narayana Health is the first one that we're speaking with this morning. Now, Narayana reported a strong set of numbers for the fourth quarter. Revenue and margins came in healthy. Growth was driven by higher domestic volumes and better realizations as well. We have Sandhya J, Group CFO at Narayana, joining in for some perspective on how this year looks like. Sandhya, thank you very much for joining in, and congratulations on what's been a good quarter for you. I think both India as well as the Cayman facility, which is up and running, they've all been firing for you quite well. So let's just break this down. I mean, if you could tell us how much of the growth was driven by higher volumes, I mean, to what extent have you seen volumes rise in the fourth quarter? And how much is pricing led? And again, some indication of where these two trajectories will be as we look at the start of this year.
Good morning. Thank you for having me here. For this year, like every year, our pricing has two parts. One is the price increase per se, which we have taken on 1st of January. We take a low single-digit price increase. So some of the growth has come from price increase, but a large part of the growth has come from realization. That is better payer mix, better, more high-value procedures, and volume increase as well. On the volume side, the domestic volumes have been quite healthy, like we've reported out. We did have a significant impact on Bangladesh. So if you look at quarter four alone, Bangladesh was a year-on-year 53% decline, whereas the domestic volumes have been very healthy, upwards of 15%, and that's kind of given us the balance in terms of performance.
Okay. The average revenue per patient apparently is up 13%. I think year-on-year it's up 13%, 9% quarter-on-quarter. Can you give us some sense of occupancies as well, and where you are expecting these metrics to stabilize, say by halfway down this year?
Sure. So our occupancies normally range in between 60 to 65%, and I think that is where we will be, because we don't look at occupancy as the key measure, but more throughput. And you would see that we have not added any bed in the past several years, but you've seen improvement across all our parameters, whether it is our margin performance or our ARPP, ALOS, and all of it is coming because the focus is more on throughput. So from an occupancy point of view, we are not guiding anything different. In terms of ARPP per se, the price increase driven ARPP will be small because we have taken a small price increase. We will continue to show growth like we have shown in the past, driven by higher realization procedures and driven by payer mix optimization.
Okay. Margins, I mean, so is 25% a very stable level that you're at, and do you think it'll be here? Or could you actually see improvement this year in the EBITDA margin?
As far as the India margins are concerned, Q4 we finished 21.5%, and as a goal, we do want to continue to expand on the India margin side. So you will definitely see improvement in the India margin going into FY26 also. Cayman will probably stabilize at this level.
At 25%?
Overall, at a group level is 25%, yes.
Okay. So we should expect some stability there. Just a word on the new hospitals, the one in Gurugram, there's one in Dharamshala. What is it that you're expecting there in terms of break-even timelines, throughput levels, as you call it? Just some guidance out there, and some sense of Capex that you might be incurring this year also. Just give us a sense of the cash levels in the company and the Capex this year. Will it be lower because you've already been, you've launched several new facilities already last year?
From a Gurugram and Dharamshala performance point of view, Dharamshala has broken even. It delivers a reasonably healthy EBITDA. Gurugram has had broken even in Q4. And we are hoping that we will be able to start generating positive EBITDA in Gurugram in FY26. As far as our capacity is concerned, we have added capacity only in Cayman in FY25, and we have announced a large Capex plan for the next 4 years. So we have already announced about 2,000 beds at an outlay of 3,000 crores for India, and we are looking at more opportunities. So a large part of those spends will come over the next 3 years. The land acquisitions have happened for many of those investments. So almost 20% of this outlay is already spent because of the land investments we have done. And then the build out will happen. As far as Cayman is concerned, there I agree with you. We have completed our capex, and you will see very, very small maintenance capex in Cayman. But there the capex outlay is completed.
So the total outlay is 3,000 crores over 3 years
Yes.
To add 2,000 beds, right?
Yes, at the moment, yes.
Okay. And how much of that will be incurred in FY26? And against that, what is the cash level? What is the existing debt level?
So our current debt, net debt to EBITDA is 0.15, so which means we're very, very healthy in terms of debt. And we are also holding a high cash balance as a group. So therefore, we will, at the moment for the current year, I don't think we will breach our aspirational net debt to EBITDA of 2. We aspire to stay under it through the capex period, but if there are some periods where we have a very good opportunity that we need to go after, we may temporarily breach that limit. But at the moment, we are looking to stay under a net debt to EBITDA of 2.
Okay. All right, Sandhya, thank you very much. Lots of details there. Quite helpful. Thank you for joining in, and good luck with the rest of the year as well.
Thank you. Thank you for having me here.